I'm looking at the chart for Cummins, ticker CMR, and then I'm looking at the earnings report they just dropped. And my brain is having a really hard time reconciling these two things.
It's a sea of red, isn't it?
It's a bloodbath. It's Thursday, February 5th, 2026. The market just closed, and Cummins is down about $65. That's a 10, almost 11% drop in one day.
And this was a stock at an all-time high just yesterday.
Exactly. Sitting at $605, priced for absolute perfection, and today it's trading around $540.
That's the problem when you're priced for perfection. Any little crack in the story gets punished. And today, we didn't just see a crack. We saw a pretty big piece of the foundation get ripped out.
But that's the part that's so confusing because, I'm looking at the top line numbers, revenue, $8.54 billion. That's a beat. The consensus was lower.
Right.
Adjusted earnings per share, $5.81. I mean, that crushed the estimate of around $5.10. So operationally, they made more money and sold more stuff than Wall Street expected.
You'd think the champagne would be popping.
Instead, the balloon popped. Why?
Because investors looked right past that adjusted number and stared at the GAAP number. And the GAAP number, the generally accepted accounting principles number, the real money was a mess.
How much of a mess?
$4.27. The street was expecting something over $5.
Wow. That is a massive miss.
It is.
Yeah.
And the reason for that miss is what triggered this entire sell-off. It wasn't because they sold fewer engines. It's because they took a $218 million charge.
And that charge was related to Accelera.
Accelera.
Yeah.
Their brand of the future. The whole zero emissions, hydrogen, and electrification part of the company.
So what is this charge? It's not just a rounding error.
No, not at all. It's an impairment, a write-down. And honestly, it's a confession.
A confession of what?
A confession that the hydrogen economy, well, it isn't happening on the timeline they promised everyone.
Okay, let's dig into that because for the last, 3 or 4 years, the entire narrative has been green hydrogen is the future. And now you have Cummins, one of the biggest players, taking this massive hit. What exactly did the CEO, Jennifer Rumsey, say?
She was pretty blunt, actually. She talked about deteriorating hydrogen adoption expectations. And because of that, they're starting a review to, quote, streamline operations.
Streamline? That's corporate speak for cutting costs.
Big time. But here's the line that really spooked the market. They are intending to completely cease new commercial activity in electrolyzers.
Wait, hold on. Stopping new commercial activity? That sounds like they're exiting the business.
Well, they're going to fulfill their existing commitment. So if you already ordered one, you'll get it. But they are not chasing new customers. They're not bidding on new projects. They are, for all intents and purposes, putting the electrolyzer business into hibernation.
That is huge. I mean, think about all the startups out there whose entire valuation is based on selling these things. And here's Cummins basically saying, yeah, we've looked at the math and we're out.
It's that classic chicken and egg problem with hydrogen. And the chickens are finally coming home to roost. You need cheap green electricity, you need the electrolyzers, and then you need a massive pipeline infrastructure to move the gas.
And right now, we don't have any of that at scale.
None of it. Not at a price point that can compete with diesel. And that's what Cummins is admitting. I mean, Accelera posted a net operating loss of $438 million for the year.
Almost $500 million.
Just gone, just incinerated, trying to create a market that isn't there yet. So this streamlining is really just stopping the bleeding.
It's a shrink to fit strategy.
Exactly. Cut the losses. They guided Accelera revenue for 2026 to be about $300 million. But the key is that the losses will narrow. So it's a financially responsible move, but if you bought the stock thinking it was a hydrogen growth story, today was a rude awakening.
It feels like a reality check for the whole sector. But here's the irony I can't get over. At the exact moment they're stepping back from the fuel of the future, they are absolutely printing money with the fuel of the past.
You're talking about the power systems segment.
I am. I mean, look at these margins. They're incredible.
It's wild. Power systems revenue up 16% to a record $7.5 billion. EBITDA margins hitting 22.7%. That's like software-level profitability on giant pieces of metal.
And this isn't just selling generators to construction sites. This is the AI trade, isn't it?
It is 100% the AI trade in disguise. Everyone's focused on NVIDIA chips and OpenAI, but what do all those chips need?
Power.
Massive amounts of it. And more importantly, they need reliable power. You can't have your billion-dollar data center flicker off because the wind stopped blowing.
So they need backup generators.
They need mission-critical backup. And that's where Cummins is just cleaning up. They specifically called out robust demand for data center backup power. They even finished expanding their capacity for the 95-liter engine ahead of schedule.
The 95-liter. Okay, for context, my car has like a 2-liter engine.
Right. So imagine an engine block the size of a small car. It's a beast. And then they launched the new 17-liter Centum series, which puts out 1 megawatt of power.
And density is the key word there because data centers are running out of physical space.
Exactly. You need the most power in the smallest box.
Yeah.
And the market is just devouring these things.
How much are they devouring them? Because I saw a note about their order book that seemed almost like a typo.
It does sound fake, but it's not. Management said they had record order intake in Q4. And get this, they're taking orders well into 2028.
2028. We're in early 2026. That's a 2-year waiting list for a diesel generator.
It is completely unheard of. You usually have maybe 6 months of visibility. 2 years means the hyperscalers, the Amazons, the Microsofts, the Googles are basically panic buying power security. They know the grid can't keep up.
So if you're an investor, you've got this totally schizophrenic story. The hydrogen future is collapsing, but the diesel present is sold out for 2 years.
And that's why the stock is so volatile today.
Yeah.
But we can't ignore the third part of the business, the bread and butter, the trucks.
Right. Because Cummins is still synonymous with the 18-wheeler. And that part of the report, well, that was kind of the ugly part of the story.
It was rough. North American heavy and medium-duty truck volumes were down roughly 30% in Q4.
30%. In the freight world, that's a recession.
Absolutely. We are sitting in the trough of the trucking cycle. Fleets aren't buying new trucks right now.
And then you layer on the tariff situation. The CFO, Mark Smith, was surprisingly blunt about that.
He was. He just came out and said tariffs were dilutive to every single segment in 2025. And for 2026, he's expecting another drag of about 50 basis points on margins.
And the kicker was the pricing comment. He said, pricing is not a big feature of 2026.
Which is code for we have no leverage. In the last couple of years, they could just pass on costs. Now, with volumes down 30%, they have to eat it.
So you have a trough in trucks, tariff headwinds, no pricing power. You'd think the 2026 guidance would be a disaster, but they're guiding revenue up 3 to 8%. How does that work?
It works because of the EPA.
Ah, the 2027 pre-buy.
You got it. There's a new low-NOx emissions rule kicking in for 2027. It's a huge change, and it's expensive.
Management put a number on it, right? $10,000 to $15,000 extra per truck.
10 to 15 grand. Plus, fleets are worried about reliability with new tech. So if you're a fleet manager, what do?
You buy the tried and true 2026 model that's 15 grand cheaper, and you know it works.
Precisely. So Cummins is banking on a massive pre-buy cycle in the second half of this year. Fleets rushing to get the last of the old models.
So they have to survive a really tough first half to get to a boom in the second half. That's the gamble.
That's the bet. And it has risk. If the economy slows down more, maybe that pre-buy doesn't happen.
Okay, let's pull it all together. Hydrogen failure, data center boom, and a truck cycle gamble. The stock gets hammered 10%. Is this a broken company or is this just a valuation reset?
I think it's a derating event. At $600, the stock was priced for everything to go right. It didn't. But look, they're still committed to returning at least 50% of cash flow to shareholders. This is a cash machine.
That cash buys them time.
Exactly. And they do have a catalyst coming up.
The Analyst Day.
May 21st in New York City. I think that's going to be the narrative reset. They've cleared the decks with this bad news. Now in May, they get to stand up and talk for 4 hours about their AI backlog.
So today's pain could be May's game, or today is the buying opportunity.
If you believe the AI infrastructure build-out is real and durable, then yeah, Cummins is suddenly one of the cheaper ways to play it.
Which brings us to my favorite part of the show. Time for the This Is Not Financial Advice segment.
I love this part. And yes, a huge disclaimer. We are just talking here. This is for entertainment. Do not risk your money based on what we're about to say.
Strictly entertainment.
Yeah.
But looking at this whole story, this divergence, I've got a trade idea. I call it the dirty cloud long.
The dirty cloud long. Okay, I'm listening. Pitch me.
The setup is this. The market is punishing Cummins because it's abandoning the green hydrogen dream. But the reality is that the AI cloud is desperate for dirty power reliability.
Right. Reliability trumps sustainability right now for data centers.
So the long side is simple. You buy Cummins here at $540. You're buying that 2-year data center backlog.
Okay, simple enough. What's the other side of the trade?
This is where it gets a little ruthless. You short the pure play green hydrogen stocks.
Oof, that's mean.
Is it? Think about the logic. Cummins has the deepest pockets, the best manufacturing, the best distribution. And they just said, we can't make the math work on this right now.
That's a powerful point. If the giant in the room is packing up and going home, what chance do the little startups have?
None. Their entire thesis just got undermined by the biggest player on the field. They're burning cash, hoping for adoption. And Cummins just confirmed adoption is deteriorating.
So you're betting that industrial reality crushes the idealistic dream. Capital is flowing to AI data centers, not to hydrogen infrastructure.
You go long the pick and shovel of the AI cloud, and you short the dream of the hydrogen economy.
It's cynical. It totally ignores ESG scores. But looking at this earnings report, it's exactly what the data is telling us.
That's the dirty cloud long. Again, don't actually do it, but it's a fun thought experiment.
It certainly fits the narrative of 2026.
So, to wrap up, a really messy quarter from Cummins. They beat on operations, but basically admitted strategic failure on the hydrogen front. The stock got punished. But underneath all that noise, the actual engines are running hotter than ever.
It's a transition year. The truck cycle is bottoming, the pre-buy is coming, and the data centers are just screaming for power. If you can stomach the volatility, the core industrial logic is still there.
And the question for you listening is pretty simple. Do you think this hydrogen exit is a failure? Or is it a smart pivot to focus on what's actually making money? Is this 10% drop a buying opportunity, or is it a warning that the industrial cycle is going to be a lot harder than we thought?
We'll probably get the real answer on May 21st.
We will definitely be watching. Thanks for diving deep with us. We'll see you on the next print.